This video is about contingent equity in a project finance transaction. Okay, so first let's talk about what is contingent equity. By definition, in a project finance transaction, we say that project finance is a non-recourse or limited recourse transaction. What does that mean? That means that lenders, they only have access to the project's cash flows for the repayment of their debts. Okay, so as we said, this doesn't mean that the sponsor they are not eligible to provide any sort of guarantees. They still need to provide some sort of guarantees, limited guarantees to the lenders, and the contingent equity is one of them. So what the lenders will say to the sponsor, they will say that, okay, I am financing 70%, 75%, 80% of this project, and so that's all that I'm going to commit. However, if things go wrong, because as you know, all the negotiations are about if things go wrong, right? So if things go wrong, you as a sponsor, you need to provide this amount of money. They're going to put a maximum, ceiling on that. You're going to provide this amount of money for cases if things go wrong, okay? And there will be maybe some kind of, in the agreement, the things as well will be mentioned that under what circumstances the sponsors, they need to provide this type of guarantee, and the lenders can tap into that reserve account or that money allocated for this kind of issues and problems. So that is what is called the contingent equity. In terms of timeline, most of the time this is required throughout the construction phase, because that's the most risky phase of the project, that they want some kind of guarantees that this project will be kind of finalized and will be operational. Even if things go wrong, there is some money that can provide for this kind of unexpected expenses or cost overrun beyond the already contingency provision provided in the package. And sometimes it even goes beyond construction, maybe up to the date that they call financial completion date. That means that when you have passed, the project has passed all the tests and basically the project is fully operational and there is evidence that the project is fully operational. So that's mainly all the things that I wanted to cover in terms of what is a contingent equity. So now we're going to go through a story, and I'm going to show you through a story what are the negotiation points and how we should model this contingent equity into our financial models. So what's going to happen that in a project finance transaction, the sponsors, they're going to put together basically the due diligence checklist that the lenders, they require. And they're going to provide most probably the EPC contract, the financial model, the shareholder agreement, the insurance policy, concession agreement, O&M contract, and any other documents that is available to them at that point in time when they want to start negotiating with the lenders. They're going to prepare that package and they're going to send it to the lenders. And the lenders, they're going to take their time to review the project documents and then come up maybe with a draft term sheet or a contract that they're going to send to the sponsors. And then it will come the time when these two parties, they need to sit together in a grandiose meeting room and negotiate the terms of the contract. And one of the things that they need to negotiate is this contingent equity that we want to discuss today. So in that meeting room, first the lenders will start on the topic of contingent equity. For the project of this magnitude and risk profile, our risk department has identified a need for 5 million euros of standby equity. This is a non-recourse transaction, and we understand that lenders are majority shareholders and want sponsor to have some skin in the game. But we have already spent 7 million euros of development capital to bring this project to this stage. And we will contribute another 30 million euros in construction equity to satisfy our 30% commitment. In addition, please note that we have 3 million euros of contingency included in the budget. Lender response: all you have said is clear. The reason why we are now here talking to you is that we trust that you are committed to this project, and we believe in your competence and eagerness to bring this project to completion together with us. However, the contingent equity is a guarantee that we require from sponsors, and it's common practice. Its purpose is to cover the risk of cost overruns and issues beyond the budget we have identified today and beyond the contingency provision provided in the budget. We have not closed a single deal so far without requiring a contingent equity commitment from sponsors. Sponsors' response: just to understand correctly, do you need cash collateral for this or an LC will do? Lenders: of course, you can back it up with an LC. Sponsors: understood. We will come back to you with a revised budget and financial model, including the contingent equity. Okay, so now it's time for the sponsors to go back to their office and try to model this contingent equity and the LC fees related to the contingent equity in their financial model. Let's go and do it together. Okay, so now we have the model open. The first thing that we want to do is to save the file under another name because we're going to send a revised version as we promised to the lenders. So we're going to save it under version 2 and we're going to start working on the financial model. So I'm just going to take you through the calculations. So I have already introduced in my input sheet under the financing assumptions, I have introduced a new set of parameters, input parameters, under the heading of contingent equity. So these are the parameters. One is the contingent equity maximum amount. So remember in the lenders meeting, lenders indicated that their risk department identified a requirement of 5 million guarantee from the sponsors. So we need to just input that 5 million in the model. The next set of assumptions are for how long do we need to keep this guarantee in place, okay? And so for now, we're going to just assume that this guarantee is required throughout the construction phase. So the start date, we linked it to the construction start date, and the end date, we linked it to the construction end date in the timing input parameters. Then the last input that we need to include is the LC fee. As you remember from the conversation with lenders, they said that of course you can back it up with an LC. You don't need to put a cash collateral, put all that money in a reserve account throughout the construction phase. You can actually back it up with an LC. However, we know that there is a fee related to this letter of credit. And let's say it is, I think 2% is too high. Let's say it's 0.5% in our base case per annum. Okay, so now that we have the inputs together, now we need to go and model this LC fee. So I'm going to come and I want to include it in the financing page or worksheet in my model because I think that's where it is suited. You can put it, if you have a one-pager model, you don't have this issue, but if you want, you can put it in CapEx, in financing, so it's mainly up to you. So I'm going to come and introduce a new section that I'm going to call contingent equity. So the first thing that I want to do, remember we defined the contingency start date and end date. So we have these two inputs that's going to bring us the flexibility. So once we start negotiating with the lenders, we know that for how long that we need to keep that contingency provision, or we need to put this contingent equity in place. And for that, we want to have this flexibility and include a flag in the model. So as you see now, for now, we know that, throughout this construction phase from January 2021 up to December 2021, we need to keep this contingency in place. So yes, so that's it. We have this done. This is a flexible model, so we have the flexibility now in this way by creating this flag and linking it to our calculation. The next thing is this fee. So we know that the model is periodic, it's not annual, although we know that the fee is 0.5% per annum. However, our model is on quarterly basis for this one. And tomorrow maybe lenders are going to come and say, no, we want a semi-annual model because the debt repayment frequency of the debt service is going to be on semi-annual basis. So we want to also bring that flexibility. That's why we're going to create this flag and to basically have the model on periodic basis and the LC fees on periodic basis. So although the fee on annual basis is 0.5%, but on quarterly basis it's going to be 0.13%. So once we have all these elements, the last thing that we need to do is to basically okay, so one thing that we need to do is to basically link this payment. Maybe I also need to link it to the flag. And so this is the maximum commitment, and we need to pay this fee every quarter to the agency, right? Banking agency that is providing this letter of credit. So we know that we need to pay 25K throughout the construction phase for this fee. And we're going to go and in our sources and uses of funds, so we're going to include this fee here as, as a contingent equity fee that is payable by the SPV and is included in our budget. So before this fee, we were just talking about a 45 million project cost. Now with this introduction of this LC fee, the project cost is a little bit higher, so we have a 25K additional cost included in the budget. So we're going to save this file and send it to the lenders and see what their reaction will be. Now that the work on the financial model is done, the sponsors, they are ready to send the financial model, including the contingent equity, to the lenders and ask for a follow-up meeting. So the lenders will take their time to review the financial model, and they will come and sit again on the negotiation table. Lenders group. We have reviewed the financial model. Thanks for the work done. However, we have noticed that the LC fee is included in the construction budget. We do not accept this to be included in the construction budget and funded partially with debt, as this is a cost to equity and should be funded directly outside the project and from the equity pockets. So remember, in our financial model, we included this contingent equity as a line in the construction budget. So as you can see, this is now included in the construction and it's going to be funded with debt and equity. Okay, so that's something that the lenders at this stage, they are objecting, and they say that this line cannot be included in the project and it should be paid outside the SPV completely, so from the mother company, from the holdco company. And of course, sponsors, they can bring up many arguments against this request and say that, during construction, we don't have any funds, additional funds, this is what we commit to pay for the cost, and this is an additional cost that we cannot pay. And if they are a fund, it's going to be even more complicated. So they can bring many arguments against this claim because this is during construction and they don't have any cash, they're not the project is not generating any cash to fund these costs, okay? So they might want to resist and provide many claims against this, not to pay this. However, lenders, they also have their own policies and they also have their own restriction, and they might not agree on this one. So it seems that our lenders and sponsors, they cannot agree on this point during this meeting, and they're going to say that seems like at this stage we should agree on not to agree on this point. And this happens on many of the points during negotiation until they come into a common conclusion. Okay, so now that they didn't agree, they need to still, the sponsors, they still want to go and build this flexibility in the financial model and evaluate what will be the impact on their return if they exclude this LC cost from the construction budget, and basically they will pay it from the holdco level, so it's going to impact their return and their IRR. So let's go back to the financial model and see what the impact will be. Okay, so back to the financial model. The first thing that we're gonna do is to save it under another name because we might want to send a revised version soon to the lenders as well. So we're gonna save it under version 3. Okay, so now back to inputs. We're gonna introduce a new input parameter, which is a switch. And it's gonna be like this. So we're gonna say is the contingent equity LC fee payable by the SPV. Okay, so that's going to be the question, and the answer, if the answer is, this is going to be a switch, meaning that if the answer is yes or the value is 1, this means that it is included in the SPV, and I'm going to have a custom formatting in form of yes and no. I like it to be like this, so it's going to represent the switch, and I have it here. Okay, so yes, so if this is 1, this means yes, and if it is 0, it means no. Okay, pretty straightforward. We don't need that percentage. Okay, so yes, so that's it, as you can see here. So this is now yes, meaning that yes, this is actually included in the SPV budget, and if it is no, this means that this is not included in the SPV budget. Okay, so now that we created the input, let's go and make the link to the calculations that we have in the financing sheet. Okay, so let's go down where we did our calculations, contingent LC, and we're going to bring in this switch here, and so that we know exactly where it is. Okay, so the answer to this question is yes. Sorry, we put a no. Okay, so we need to introduce another line, and this is going to be whether the contingent equity is payable by holdco. So it's going to be outside the SPV budget. Okay, so now we're going to have to make another link. So this is switch is 0, right? So this means that this is not included in the SPV. Okay, so if it is not included in the SPV, this means that it's going to be exactly the same formula. Let me see if I can drag it down. Okay, so I didn't fix this one. Okay, so not. So if this switch is in no, this means that this fee is payable at holdco level. Okay, so exact same fee. Let's see where I did wrong. That's the flag. Also, I didn't fix it. Sorry about that. Okay, so as you can see here, so now that same exact fee, remember it was 25K. It is not paid by the holdco level. So let's go to our construction budget. You see that it is not here, it is 0. So our construction cost is that 45 million, okay, without the LC. So what should we do with this holdco level LC? So what we need to do to evaluate the impact on our return, because that's a fee that needs to be paid. If it is not paid by the SPV, it's going to be paid by the shareholders directly. So that's where I do the calculation for the IRR. And I need to introduce that here. So it's going to be an additional cash outflow for my shareholders, right? So I'm going to come and link it here to my IRR calculation or return calculation and make the link. So now I have this cost that needs to be paid as part of the cash outflow of the project. So I'm going to come and make the link, and as you can see, it will have an impact on the IRR. Okay, and it's not that much, but maybe we need additional digits to see the impact, and we're going to look at it right now. Okay, so that's how you see, so it's going to come as an additional line in the IRR calculation. So let's just see the impact on the total project cost and equity IRR. So this is a simple sheet that I actually used from Professor Edward Wadmer. I'm going to put the link down below. It's just, it's going to make it easy for you to do scenario analysis and save your results. Let me just first go back and put that switch to yes. So that's part of so now the LC is included in the budget. As you can see, we have this total project cost of $45.025 million. And I'm going to come here. I think I made a mistake. This should be USD. Okay, so I'm going to copy this scenario as the base case, and I'm going to call it LC fee contingent equity. Contingent equity LC fee included in the budget, SPV budget. Okay. And I'm going to copy it as the base case, okay? And now I'm going to go and put that switch to 0, so meaning that this is paid at the holdco level. And I'm going to copy this one as well, and fee excluded. So it's not excluded, it's excluded. It's payable by the holdco level. So as you can see, the difference is that 25K, right? And the difference in percentages is also, as you can see, we have a 0.01% reduction in the equity IRR because of this cost. So that might not be very significant, or in some project that even that much might be, you know, the sponsor might be very sensitive. Maybe they are really reaching their hurdle, and any kind of change on their IRR is negative for them, and they cannot basically tolerate that. So it all depends on the sensitivity they have, and these are all the points of negotiations. Okay, so I hope that this was helpful and you could understand what is a contingent equity, what are the points of negotiations, and how to model the LC fee into your financial models. And I'm going to continue on this topic. Maybe in my next video, I'm going to talk about another guarantee required from the sponsors, which is the guarantee of their commitments throughout the construction, equity commitment throughout their construction, if the drawdown is done on pro rata basis. I'm going to tell you all about that in my next video. I hope you liked it. And if you like this kind of content, consider subscribing to my channel. And any comments, any feedback will be welcome as well. Thank you, and I hope to see you in my next video. Bye. If you want to learn how to build better financial models, check out my online course on financial model spreadsheet design at courses.phoenixmode.com.